Hello, I'm Rene Ruiz with Nationwide Purchase Loans, and I thank those of you that have already subscribed. To those of you that haven't, please do in order to support us. We really appreciate it. Today's video is going to be on the Consumer Financial Protection Bureau, which certainly most of us have seen in headlines, and the purpose is to do a slight history lesson on where they came from. I want to talk about what they've accomplished and what it might mean now that they're going to be gone. So let's go ahead and get started. All right, so who are they? The Consumer Financial Protection Bureau, which was created in 2011 in connection with the Dodd-Frank Wall Street Reform and Consumer Act. It was essentially passed by Congress in 2010 and primarily created to provide oversight. All of this in response to the 2008 financial crisis. So who cares and why? I do, and the banks, and you should too, and apparently so does our new administration. Trump went after the CFPB in his previous term, trying to forcefully replace the director. But this time it's different.
We virtually shut down the out-of-control CFPB, escorting radical left bureaucrats out of the building and locking the doors behind them. What they were doing was so terrible. Where they were spending the money was so terrible.
So what happened again? On February 10th of this year, the new CFPB chief closed all offices and issued a stop work order to all employees and contractors. All pending investigations ceased, all public social media accounts got closed, and it appears that this is the end of the CFPB. What good have they done? Well, they caught some big banks doing some redlining, which means that they were doing more business in certain areas where there was more affluent and, racially sensitive kind of stuff. Forcing big banks to enact policies to protect consumers from fraud, reduced and worked to eliminate bank overdraft fees, and banned medical debt from credit reports, which in my opinion, I would say these are all good things. What about the bad? Well, it was highly criticized for being funded directly by the Fed and controlling its own budget, and was only controlled by one director, which is not normal. Most federal agencies are going to have multiple directors that have control. And this director could only be replaced under very specific circumstances. This was done on purpose to prevent political changes to have an effect on the CFPB's ability to do its job. But here we are. It enacted so many rules that it created a regulatory burden which critics claim stifled innovation and competition, resulting in restricted credit availability to consumers. And you know what? I actually kind of agree. So what's the ugly? TRID were rules that got put into place in 2012 after about a year of the CFPB being around and doing their research on how they thought mortgage disclosures needed to be revamped. And it was a good thing in that we ended up with standard format for loan disclosures, loan estimates, and closing disclosures. But we saw new waiting periods that ended up costing consumers. And unfortunately, I have seen transactions where someone didn't get the house because they couldn't make it past a certain wait period because they had fallen behind in the loan process. Ultimately, there are good things too, like requirements for ability to repay. These were also called QM rules, qualified mortgage rules. And they prohibited certain bad things like prepayment penalties on primary residences. There was a cost limit of 3% on home loans for primary residences as well, and that's a good thing for consumers. The requirement that lenders verify ability to make payments seems like it would have been a no-brainer, but it wasn't a requirement by law, and it became a requirement after the new rules got put into place by the CFPB. So what will happen now? No one really knows. Rumor has it that our administration plans on a new federal agency tasked with consumer protection, and some expect lending to get easier and cheaper if those waiting periods go away, if these additional requirements that really do cost lenders more money. Imagine, before we had all of these disclosure requirements, lenders were operating based on the format and the procedures that they used to use. Well, these new rules went into effect and they literally had to hire people to do those disclosures. They had to buy software and create programs that were actually going to be able to do things efficiently. And it ended up costing them money. It is more expensive to do home loans because of the CFPB. Others fear we will see a repeat of the 2008 financial crisis. I am not so certain, but at this point, I know anything can happen. A few things to remember: things are still developing. Education is the most important protection that consumers have. So please watch some of our other videos. And if you can think of any other videos you'd like us to cover, let us know. And don't forget, we are here to help. Thank you for joining us. And don't forget to hit the subscribe button. Have a beautiful day.